You do not need an LLC. You do not need an S Corp. You don't need a corporation. You don't need any of that stuff to be able to have write-offs. If you are generating income, selling lemonade out in front of your house, or owning a rental property, you can have as many write-offs as you deem reasonable that would help you generate that income.
All right, so I'm here talking with Sean Daly, who's a CPA and a local real estate investor in my area. And I want Sean to get into some of the details that are involved with tax strategies, saving taxes for real estate investors specifically.
All right, great. Thanks, Vitaly. So here is the investor's guide into the tax world. Put this, very small PowerPoint together here to kind of help us out and, bring some good tax advice to real estate investors. I get this question all the time. I don't have a business. I can't have write-offs. And that is one of the largest misconceptions as a tax professional that I see in my career. You do not need an LLC. You do not need an S Corp. You don't need a corporation. You don't need any of that stuff to be able to have write-offs. If you are generating income, selling lemonade out in front of your house, or owning a rental property, you can have as many write-offs as you deem reasonable that would help you generate that income. Whatever it takes for you to do to sell that cup of lemonade, whatever it takes you to earn that month's rent, you can use that expense as a write-off. So that's very important for people to understand, at least from a tax perspective. Now, as a real estate investor, what can I write off? So obviously insurance, property taxes, water, sewer, HOAs, mortgage interest. If you're paying commissions, maybe you have a leasing agent helping you out. Maybe you have a realtor that helps you, rent out the properties. Education and training. Bigger Pockets has a handful of books out there. They have a handful of podcasts. If you're paying this stuff to try to learn to buy another rental property, you can use those expenses as a write-off. You are trying to educate yourself to generate more income. Obviously, marketing and advertising, mileage rate. If you have to go to the bank and cash a check a tenant gave to you, if you have to run to Home Depot and run back to pick up a toilet because it broke, those miles that you're driving could be used as an expense to offset your rental income. Obviously, pens, papers, if you're buying small supplies, materials and stuff, if you buy a receipt book and you give it to your tenants to, give them a receipt on the rent paid, like those things, obviously you can write off. Meals. So, if you go out to lunch with your real estate agent, if you go out to lunch with your attorney, if you go out to lunch with a client, maybe you go out to lunch with a seller that is thinking about selling their property and you just want to buy them a cup of coffee. Those things you can write off. In 2022, they're allowing 100% of those meals to be written off. In the past, in 2021, it was 100% as well too. But moving forward in 2023, it'll go back to 50%. So if you bought a cup of coffee, it cost you $2. You can only write off $1 on your tax return. Again, you don't need to know that as an investor. You just need to know that difference is out there, and your CPA should be able to adjust those things on your tax return for you. Fees, license, membership to the MLS system, which is our multiple listing system we use here in the Albany area as a real estate agent. Those things, obviously you can write off any bank fees, subscriptions, things like that. Software is business tools. If you buy a laptop because you need to do more research, if you buy a piece of equipment, if you're using your phone to make phone calls to your tenants, to your attorney, to your contractor, well, take a reasonable percentage of your phone bill. If your phone bill is $100 a month and you probably use it 50% of the time for real estate, well, 50% of your phone bill can be a write-off. Significant travel, if you really are thinking about buying a rental property in a specific location. We live in New York here. If I wanted to travel to Florida to really look at some property, make sure you have good documentation down. But, you could be able to essentially write off that entire trip. Again, work with your CPA on the exact amounts and, what would be actually being able to a write off or not. And then again, I always get the question like, well, Sean, how do I keep track of this stuff? I got a million receipts here. They're in my glove compartment. They're in my house in a folder. The best way to do it is to really open up a single bank account and flow everything through that one bank account. Then at any given point, if you need to pull a receipt or you need to have your accountant or your CPA work through things, they have all of their information in one bank account. Those bank accounts can be linked to QuickBooks nowadays. They can be linked to many different things to be able to extract the data out that you need to generate the expense list that you need to create to basically give to your CPA.
And one caveat I just want to add with that advice, I think that's really good advice. If you're buying things in separate LLCs and you have business partners in those LLCs,
yep,
I would suggest, and I'm sure you would agree, to have separate bank accounts for each one of those entities, because technically they are all their own, not only tax entities, but also legal entities for the purposes of both liability separation and tax planning and tax strategies. And I think what Sean is saying here is if you own things in your own name, if you own rental properties in your own name, then yes, you should have a separate bank account for your business, for your rental properties. But if you have multiple different LLCs, as I do, and as Sean, as you do, you want to separate not only those LLCs, but also separate your bank accounts for both the tax purposes and liability purposes. Would you agree?
I would agree 100%. And just to kind of piggyback off that, the tax forms are designed to have every rental property building separated on your tax return. So the best way to do that is, and sometimes it might be a little bit more costly, and sometimes it might be a little bit more accounting work, but the best way to make sure that it's done correctly and to make sure that you're not missing anything would be to maybe even have a separate bank account for every property. So if you have one LLC, but you have 5 properties in that LLC, you can open up 5 business accounts. Property A business account, property B business account. Then that way flow all of the income and expenses through in each individual properties. Then at the end of the year, you have your profit and loss already done for each individual property that you could give to your accountant. And it just simplifies everything rather than your personal credit card over here, my sister's credit card over there, my personal bank over here, my piggy bank for my cash, so on and so forth. It just simplifies everything if you have it, structured that way.